There's a very common scene in today's market. An investor opens their investment app, they see a major tech company and it rises consistently, and they conclude that the most obvious strategy is simply to invest in technology. Now, at first glance, that decision seems logical. After all, companies connected to artificial intelligence, cloud computing, and semiconductors are among the most valuable in the world. But there's an important detail many investors overlook. The biggest mistake of those who decide to invest in technology today is not choosing the wrong sector, it's how that investment is interpreted. I'm Chad. If you don't know me yet, here you'll find weekly content designed to make you more critical and more connected to the market. In recent years, the technology sector has become one of the main engines of the global financial market. Companies such as Apple, Microsoft, Nvidia, Amazon, those companies have come to represent a massive share of U.S. indexes driven by advances in AI, software, and digital infrastructure. This growth has led many investors to the same conclusion. If technology is shaping the future of the economy, then investing in technology seems like one of the safest decisions in the market. But when we analyze the history of financial markets, we realize that investors' biggest mistakes rarely happen when they choose a promising sector. They happen when a good idea becomes such a dominant narrative that people stop questioning the risks involved. And that is exactly what can happen when everyone begins investing in technology with the same expectations. There's an interesting dynamic in markets. Many of the best opportunities begin as ideas that only a few investors are paying attention to. Over time, these ideas gain momentum, they attract more capital, and eventually they become a consensus in the market. That is exactly what happened in the technology sector. For decades, companies in this space have created products that change the way the world works. Smartphones, digital platforms, cloud computing, and now AI have moved to the center of the global economy. As a result, investing in technology has almost become synonymous with investing in the future. The problem is that when an idea becomes a complete consensus, prices often begin reflecting extremely optimistic expectations. The biggest mistake of those who decide to invest in technology today is not believing in the potential of these companies. In fact, much of that potential is real. Technology continues to be one of the most powerful forces transforming the economy. The most common mistake is assuming that extraordinary companies automatically represent extraordinary investments at any price. In financial markets, there is an important difference between company quality and the price paid for that company. A company may be extremely innovative and still represent a risky investment if the market is already pricing in very high expectations for the future. Market history shows that innovation cycles often follow similar phases. First, a new transformative technology emerges, then investors begin to recognize the potential of that change. And then after that, enthusiasm grows and more capital starts flowing into the sector. During this process, investing in technology can feel like an obvious strategy, but at certain moments, the market may begin pricing in years or even decades of future growth into current valuations. That does not mean technology will stop growing. It simply means that at times, the price investors pay can become just as important as the innovation itself. Technology will likely remain one of the most powerful forces transforming the global economy in the coming decades. Artificial intelligence, automation, and digital infrastructure still hold enormous potential growth, but understanding how to invest in technology requires more than simply identifying promising trends. It also requires analyzing expectations, market valuations, and the collective behavior of investors. Because in the end, the biggest mistakes in financial markets rarely happen when people choose the wrong sector. They happen when an idea becomes so powerful and widely accepted that few investors still stop to question the risks involved. If you want to understand how to analyze trends, risks, and opportunities in the global financial market, follow Zero Markets. Our goal is not just to observe which sectors are growing, but to understand how these movements actually form within the market.